What's up everyone, it's Kadi with Moneyvesting. So doing this live stream a little bit earlier because we do have the European Central Bank Forum, so ECB Forum going on right now. So pre-market, we are slightly down. QQQ is, actually it's slightly up over 29 basis points. We got the SPY up over 35 basis points and the Dow Jones is also up over 38 basis points. But we are going to listen in on the European Central Bank. There are some very key speakers. Jerome Powell is going to be coming on in about an hour. But until then, we're just going to listen in on some of the other panelists and other speakers as well, and wait for Jerome Powell to come on board along with Christine Lagarde. So it's about an hour till they come on board, but we will listen in on some of the other panelists as well. So let me know in the live chat if you guys can actually hear this audio, and we should be all set and all good to go. So just give me 1 second here, and let me know if you guys can hear this.
Earlier this year and has now settled slightly above 2% in recent weeks. Survey-based measures of inflation expectations have gradually crept up towards our 2% inflation target, or have even moved above 2% as the median in our consumer expectations survey. In the baseline scenario of our staff projections, inflation is projected to stay high for an extended period of time, but to return to around 2% over the medium term. And these developments raise a number of important questions for policymakers, and this is precisely what we would like to discuss in today's panel. So what is and should be the role of inflation expectations in monetary policy making? Which inflation expectations do actually matter? Those embedded in market prices, those by professional forecasters, or those by households and firms? How can we detect risks of de-anchoring? And finally, how can policymakers ensure that inflation expectations remain well anchored when inflation is expected to remain above target over a prolonged period of time? So these are the questions that I want to discuss with my four excellent panelists, which I will introduce one by one as they speak. And it is, of course, natural to start where the discussion ended last year. So I'm delighted to give the floor to Ricardo Reis, who is Professor of Economics at the London School of Economics, and who last fall published a fascinating Brookings paper on losing the inflation anchor. At the time of our previous ECB forum, Ricardo was of the view that inflation expectations in the euro area most likely would stay anchored. But he asked central banks to make clear that if inflation turned out to be permanent, they would do whatever it takes to stay within their mandate of price stability. So, of course, we are excited to hear how your views have evolved since then. Ricardo, the floor is yours.
Thank you. Oh, wait, my glass is going to fall. Well, thank you so much for having me to talk here about inflation expectations. And so let me try to give you where I think inflation expectations are in the euro area right now and what challenges they pose for monetary policy. But to start, how do we go about measuring expectations? As Isabel already noted, we have three options. We can ask people, and for that, the best publicly available data is the one produced by the Bundesbank, which has an online survey on consumer expectations with data available since 2019. And soon we'll also have one conducted by the ECB coming live. We all know, or not we all, some of you may know that when one asks surveys of people of expected inflation, you always worry about the fact that people have biases, they overreact to news, and more generally that over the last 20 years when inflation was very stable, the signal to noise ends up being very small, partly because there is so much noise in this data. Moreover, not only we can ask people about expectations 1 year ahead, or we can ask them at longer horizons. But whether you ask 3, 5, or 10 years, you tend to get the same answer. Indeed, the Bundesbank asks 5 and 10 years ahead and pretty much gets the same answer, showing that people really can't distinguish that much between these different horizons. If you ask markets, the best publicly available data is the ECB survey of professional forecasters, now complemented again soon with a survey of monetary analysts. And that on the one hand has a lot of signal to noise and does quite well in the previous 20 years, but suffer from strategic behavior. Many of these professionals want to look different from others. After all, often they're paid for their advice, and that advice better be a little bit different than everyone else. But at the same time, they suffer from conformism insofar as they spend a lot of time in conferences like this and end up being driven by the arguments in it. And more importantly, as in that Brookings paper I noted, if you look at the record of when we had large turning points and we had good professionals data, early 1970s US, inflation going up, Volcker, inflation going down, the professionals were way off. They really were they were as surprised as central bank, I guess, is a way of putting it. Third option is to measure market prices using inflation swaps, options, in the case of the US, break-evens, in the euro less so, where the difficulties there is that you need to take out compensation for risk, and we know how the price and quantity of risk in markets changes a lot, as well as just noise having to do with liquidity and all kinds of trading frictions beyond adjusting horizons and payoffs. Let me do that. Let me look at these 3 types. By doing that, I'm plotting here from the Bundesbank 1 year ahead the expected inflation. Important, you need to adjust it, and I have a simple formula there that you barely can read that comes from previous work that I had to adjust for standard deviation and skewness, which is a very simple way to back out the noise, to take out some of the biases of people. The markets in blue and the professionals in green. It's clear that in 2021, households started moving faster a little bit than the markets did, but both very much together. And then in 2022, we have especially the market prices rising significantly more as perhaps you start having risk compensation increasing as a recession became more likely and high inflation starts being associated with a recession. Therefore making sense of why blue got a little bit steeper than red after they had moved together. The professionals were mostly useless in detecting the increase in the inflation 1 year ahead. And notably, in the last 3 months, and as we expect the new wave of the Bundesbank survey, which will come pretty soon, what we see is actually that from the markets, the older we have, very steady market prices, if anything, a reversal as monetary policy tightens. And again, let's wait for what the people think. That's the 1 year ahead, and one that we can judge and say, well, some people were, apologies for my rudeness, a little useless insofar as we already know a little bit what the inflation was or is very likely to be. But let's look at the harder question, but maybe the more important question. What if it looks 5 years ahead, and where perhaps we can also average over the biases and overinterpretation of people? Well, 5 years ahead, you see a very similar pattern where households increased, markets much more after January, and again, the professionals lag behind. So if you want to think about whether inflation are anchored in the sense of the next 5 years, you get a similar image of somewhat of a de-anchoring starting after I made those statements, Isabel, and speeding up at the beginning of this year. Now, this, if you looks at all 3 of them, but in trying to, instead of pick between the 3, why not use a method that tries to combine them to come up with a method? And here's a lot of equations to convince you that I'm serious, but this all to say that these are a model that tries to extract some of the biases, allows for overreaction, sluggishness, and essentially combines these 3 lines, these 3 series, with measures of disagreement and skewness that allow you to put more or less weight on the people versus the markets. If you do that, here is what Eurozone expected 5-year inflation is since starting in 2024. I purposely did not put a number in the vertical axis. Why? Because that's an assumption. I have to start it somewhere. If I started at 2, then expected inflation would have risen to 5. Started at 1, it will have risen to 4. What happened? Why does it increase in these 2 steps? Well, first, when one looks at the data to decompose what the model is doing, is that skewness and dispersion increased at first in mid-2021. And then, as the market prices rose, the model says, aha, indeed, expected inflation must have increased. First, the skewness and dispersion, then the asset prices, finally the median changes. What happened in the very last data point? The very sharp increase in markets, and given the difficulty in this model accounted for change in composition of risk, maybe perhaps lead to an overstatement. So I don't completely buy that last small number over there. Let's wait for a little more data. It's probably 0.5% to 1% lower. Either way, the new anchor, if before, let's say, was 1%, now seems to be 2.5%, or maybe even as high as 3.5% or so, according to what the data on expectations is showing. Why is that? Well, the picture from the Bundesbank survey shows it somewhat clearly. This is the histogram of the answers that people are giving. And what you see is that it's not just that expectations are unanchored in the sense of a flatter distribution. The distribution has shifted horizontally to the right now, to 1.5% to 2% higher. If one starts from the perspective that, now, let's, good and bad, glass half full, glass half empty, is on the one hand, they are stable now at somewhere like, again, 4% here. When one corrects for biases, compensation for risks and others, one could say it's more like a 3 to 4% is the right amount. And note, before you start dismissing, oh, households, I go to too many conferences where people say, oh, these households, they don't know what they're talking about. Remember how they were pretty much on track, not so the professionals, when it came to the 1 year. And now, think about it. If inflation is 8% this year, 5% next year, 3% the other, and 2% and 2%, that averages to exactly 4%. That does not seem like a crazy, out-of-touch household. May not be the outcome one wants, but certainly one that seems somewhat plausible. Moreover, perhaps German households are particularly sensitive, and therefore this is an upper bound, but this is to say that this is a reasonable estimate. On the other hand, is this a worrying estimate? Perhaps, if for 5 years, average, again, having an estimate around 3.5%, 4% seems reasonable. If instead it was 4% in a 5-year horizon, that would be worrying given a target of 2%. But as I told you, you really cannot torture the data to tell you that because the people just don't distinguish this very well. And moreover, it is not that now expectations are an anchor, they're anchored at some number above the 2% target. Whether that's 2.5%, 3%, I don't know, but certainly somewhat above 2%. If you want to look at longer horizons in a 5-year horizon, then you really want to, the only way you can do is markets. Markets do separate 5-year from 5 years ahead. And there, like I said, you struggle with separating for plausible risk premia. This increase all in the Eurozone, 5-year expected inflation, I think can be too glibly dismissed as purely compensation for risk. That would be a 1.2% in compensation for risk change in inflation. That's what some of the estimates from the ECB models would say. It's very hard to write a model that has a 1.2% increase in the risk premium with no change in fundamental whatsoever over this period. But let me leave it at that. To say instead that if one looks at the distributions, skip ahead. If one uses distributions to back out instead these probabilities of inflation being high in this 5-year horizon, what one gets is that the ECB, and takes that as a measure of credibility insofar as being this far horizon, one gets a perhaps worrying, perhaps not shocking increase from essentially 0 to around 6% around January, December, but since then very little change. These are the very last numbers that I calculated 2 days ago. For June is the last number. You get, again, a likelihood if you want that maybe the ECB will not be able to control inflation at 2% at this long horizon, which again seems credible, and again, glass half full, glass half empty. But should you care? Having looked at the data, I conclude that expectations seem reasonable, sensible, the data is giving sensible things, and they say that perhaps the inflation expectations are a little above where the target is, and with a risk of staying above higher. Should you care? Well, for that you need a model. And so let me write the simplest new Keynesian model, the 3 Keynesian model, because I thought it would be the more familiar to this audience, but I think the points I'm going to make are independent of really the model itself. What happens when you have rational expectations? Well, expected inflation stays on target, at the target being pi upper bar, and the actual inflation deviates from that insofar as we have either shocks to potential, what I call here A, where if you're a very hawkish central bank with a high phi, then you really kill those, and you achieve the so-called divine coincidence. And in response to a supply shock to the gap between efficient potential, well, inflation again rises, but how much depends on how dovish you are. And if you are infinitely dovish, you really let interest rates respond a lot to any deviation of output gap, then you end up with Z coefficient there goes to 1. Essentially, all of the shock goes to inflation. So then, what happens if we have measures of expected inflation, pi e, that you measured, the numbers I showed you, and that turned out to have gone up? Well, if they are pure noise, you should not respond to them. Theta should be zero in the response function of the central bank. Of course, if they're pure noise, you're just introducing noise to monetary policy. You would be tightening too much by responding to my, things seem to be a little bit above 2, perhaps. But what if people, in all their stupidity, wrongness, answering things wrong, act on it? That is, they, from the first equation, what if people expecting inflation set higher wages and or set higher prices in the case of firms? What if people expecting higher inflation, therefore taking account of lower real returns on their savings, decide to spend more, and through hand to mouth, and that again, expected inflation comes with more consumption spending? Well, if that is the case on both of them, then you want definitely to respond to expected inflation. For even if this pi was a deviation from expectations, as long as people are responding to it, they are pushing up aggregate demand, they're pushing up aggregate supply. They're just raising wages, raising prices, raising consumption as a response to it. What if instead people, when they're raising their inflation expectations, are overreacting to supply shocks? Maybe it's all about the supply shock Z, but that Z sadly comes with, again, these very, very terrible citizens that we have to shepherd, coming with raising their inflation expectations with a coefficient beta there that can be maybe small, maybe large. Some people often will say, oh, people just overreact supply shocks. They shouldn't be doing it. Again, if they do, though, they're going to spend more, set higher wages, set higher prices. At a minimum, the central bank wants to overreact as much as they do, and potentially more, depending on how much you care about inflation output and how dovish or hawkish you are. But if people overreact, they not overreact in their survey answers, they overreact in their behavior. And if they overreact in their behavior, then to offset the inflation that comes from it, one has to overreact as well. And finally, what if instead it's long-run creditability? What if instead these overreactions are coming up as a deviation of expectations that persists over time? In that case, the central bank, in order to keep inflation on target, need not just react to it, but actually react extremely swiftly and very aggressively. This is sometimes what's seen as the unanchoring of long-run expectations. For that is the only way to prevent a prolonged and very large deviation of inflation from target as a result of those unanchored, slowly moving expectation of inflation that arose. So again, now you want to have a very high theta, a theta that's at least as large as delta, that is the extent to which people are myopic in their expectations. To conclude, if policy is just not only and only if you think that the drift of expectations is pure noise that no one is acting on, nothing in the short run, nothing in the long run, should you ignore it. Otherwise, a movement up implies a tightening, and how much one tightens depends on whether you think it's driving actions, responding to market shocks, leads to more reaction, and doubts on credibility. To conclude, can we measure expected inflation accurately? No. And yet, we can look at data and get signals. And the signals that come, looking both now exposed to the performance of our people perform expectations a year ago, and now that we have a year of data to see the inflation, tell us that, and then contrast that with the 5-year expectations, give a coherent account that, in my view, makes it hard to dismiss expectations as being irrelevant or a bottle something theory. I forgot what the name was that you said, Isabel, that Charles had said last year. What is the best measure of expected inflation? Isabel asked in introduction. None. Better to combine them. Combining them suggests an anchor that is somewhere around 3 to 4%. On the one hand, fine, that may be consistent with even projects what inflation will do. On the other hand, concerning if it persists, but with some upside risk. Longer horizons, is the ECB target still credible? Yes, it's a small probability of 5-6% that is being revealed by the market prices, but at the same time, there is a little bit of that upside risk. And so, given the upside risk, both in the short run and in the long run, should a central bank respond to noisy upside risk? And the answer is that unless you're very confident that this is truly noise, then not even the guys saying are taking seriously. They're not even taking themselves seriously, the response to surveys. Otherwise, it suggests tightening with a different vigor depending on whether you think it is driving the measures up. And I've gone way over time, apologies, but the answer to Charles Goodhart, measure expectations matter for monetary policy. Thank you.
Thank you so much, Ricardo, for an excellent presentation. Let me now come to the second speaker. So I'm delighted to welcome Loretta Mester, who is President and CEO of the Federal Reserve Bank of Cleveland, and a very vocal member of the Federal Open Market Committee. Not so long ago, Loretta said in a speech delivered at another ECB conference that a risk management perspective argues for caution because inflation risks are to the upside and because the longer inflation runs above our goal, the higher the risk that long-term inflation expectations will become unanchored, thereby making the return to price stability much more costly. We are very happy to hear more about how the Fed is using such a risk management approach. So thank you so much for being here, Loretta. We are very much looking forward to your intervention.
Okay. Well, thank you, Isabel. Thank you, fellow panelists, and thanks ECB for inviting me to speak today. I'm really happy to be here, and the whole conference has just been wonderful. So what I thought I would do in brief opening remarks is talk about inflation expectations from a practitioner's point of view, and a practitioner from the US. So I thought I'd talk a little bit about theory, a little bit about practice, and then sort of an approach. So very simply, inflation expectations have been a central feature in models of inflation dynamics since the 60s and 70s. Phelps, Friedman, Lucas all talked about the role of inflation expectations. And they do play a key role in the new Keynesian DSG models that are used to inform monetary policy at many central banks across the globe. Now, in many of the central bank inflation models, some measure of a resource utilization gap helps to determine inflation. Lagged inflation is included in the models to capture inertia in the inflation process, and some measure of inflation expectations is included in the model. And the different models put different weights on these three factors, but household and business expectations matter since they affect wage demands and offers, and therefore the firm's price setting behavior. And the Cleveland Fed has an Institute on Inflation and Inflation Research, and they've been doing a lot of research, and they've found that including measures of inflation expectations actually improves the inflation forecasting models, although I know there are papers out there that find that they don't improve them that much. Anecdotal information indicates that businesses do base pricing decisions on their expectations about inflation. And there's recent research that documents that high inflation expectations cause firms or lead firms to raise their prices. The inflation expectations, and this is something Ricardo talked about, also provide an indication of how credible the public finds the central bank's commitment to achieving its policy goals. So if you look at the Federal Reserve's monetary policy framework, it emphasizes the role of well-anchored inflation expectations in helping to maintain and achieve price stability. And it wasn't until 2012 that the FOMC actually first established an explicit 2% longer run goal for inflation. And then when we revised our statement on longer run goals and monetary policy strategy in 2020, it really emphasized the role that the committee puts on longer term inflation expectations that need to be well anchored at 2%, and their contribution to helping us achieve both of our policy goals, full employment or maximum employment and price stability. So now the problem is there's various ways to define well anchored. So here I'm going to be using well anchored to mean longer term inflation expectations that are insensitive to the data and are at levels consistent with 2% inflation. And of course, this definition then would depend on the public understanding the central bank's inflation goal and how strongly it believes the central bank is committed to returning inflation to goal when it's deviated. So what that underscores is the role, or the very important role, that central bank communications plays in really keeping inflation expectations anchored, and via that channel, communications can help mitigate the persistence of shocks to inflation. So, if you go back to the three factors here, inflation expectations that are anchored can help mitigate the pull of resource gaps on inflation, and therefore the cyclical movements in interest rates that policymakers induce to maintain price stability need not be as large as when inflation expectations are not well anchored. And I think this is consistent with what Ricardo just talked about. And that's particularly useful at the zero lower bound when it constrains interest rates. So, arguably the US would have had much lower inflation during the Great Recession had inflation expectations not been relatively stable, offsetting some of that influence the negative output gap had on inflation. And similarly, in the face of today's very high inflation readings, if inflation expectations were to become unanchored, then their influence would offset the impact of any beneficial change in the output gap, and monetary policy would have to act much more forcefully to return inflation to the goal. So I think the theory is very compelling. I mean, I think, theory is very compelling. Real world doesn't always cooperate. So, you remember Japan, right? For a long time, inflation expectations have run well above their actual inflation rates for a number of years. So one of the first thing a policymaker has to do is to confront that, the theory speaks of inflation expectations, but those expectations are not directly observable. I mean, in the model, if you have a rational expectations model, right, the unobservability doesn't come into it because the inflation expectations are model consistent, so you can calculate them. But in the real world, that's not true. So we look at a number of different measures, and Ricardo showed a number of measures for the Eurozone. These measures differ by type of agent and time horizon. And there's measures based on consumer surveys, there's surveys of businesses, there are professional forecasters surveys, and then there's the measures derived from financial markets. Now, in practice, I think if you want to get an indication of where inflation expectations are and where they're going, you need to look at all those measures. You can't just pick one. But when you do that, you see that a clear signal isn't always forthcoming. Some of the measures move in different ways. And the research just shows that different groups of agents can behave very differently from one another. The literature has not informed us, not firmly established, whose expectations matter. And even within a particular group of agents, even if you say consumers, there's considerable heterogeneity across consumers. So we're doing some measures which we call indirect consumer inflation expectations at the Cleveland Fed. And basically it's an idea based on indirect utility. So you ask the question, okay, given the basket of goods you buy, so it's personal to the person answering the survey, how much would your income have to rise in a year or a 5-year horizon for you to be as well off so you can still afford that basket? So in other words, rather than sort of ask them directly, tell us what your what's your expectations of inflation, a lot of our work says people don't even know what inflation is, right? What's this indirect thing? If you look at that, what we get in the data is these expectations of inflation from this indirect measure, and this is in the literature elsewhere, they vary by demographic and socioeconomic factors. So women tend to have higher expectations than men. More wealthy people have higher expectations. So again, that isn't really in the models that we have. The prices of particular salient items like food and energy also seem to affect inflation expectations. They can have outsized effects. The empirical results also show that we don't really understand the direction of causality, right? It's not clear. So, do high inflation measures cause inflation expectations to rise? Or do higher expectations about inflation affect the decision making, which is something Ricardo was getting at, leading to higher inflation, or is it both? So it's a problem because you have to then infer something and it's not even clear from reduced form estimates which way it goes. And the other thing we know is that while businesses are the ones that set prices, we only have limited information on inflation expectations for businesses, although work's being done both in the ECB is doing work and the Fed is doing work to try to increase our knowledge of business expectations. I think another very practical consideration for policymakers is how to assess whether inflation expectations are becoming unanchored from the target. And relatedly, the level of degree or the level of the central bank's credibility in the eyes of the public. So you can look at levels of longer term expectations relative to shorter term expectations to get some indication. For example, if longer term expectations are stable in the face of a positive shock to inflation, then that would be some indication the public believes inflation will come down. Although it need not indicate that they believe that monetary policy will be the main driver of that reduction. And in addition to the stability of the mean or median level, dispersion across survey respondents might also indicate how well inflation expectations are anchored, with lower dispersion indicating better anchoring. So I think we need to be looking at all those measures. We have to look across different actors, agents in the economy, to understand their expectations. And we need to look at more than just mean or medians. We need to look at distributions. Policymakers also have to contend with the possibility that financial markets may have more confidence than the general public in the central bank's ability and commitment to bring inflation back to goal. And I think that, again, it suggests that policy communications are going to be important for keeping inflation expectations anchored. So taken all together, the research suggests that there's still much to learn about how inflation expectations are formed. Yet, as a policymaker, we need to make decisions based on the limited information we have. And the recent data in the US indicate that longer term inflation expectations are still below current inflation readings. So you might infer that the public expects inflation to come back down from its unacceptably high level. But if you look at measures of longer term expectations, they are rising at longer horizons, and that's problematic. And if you look at dispersion, and this is household expectations, that dispersion across survey respondents is also increasing. So this is looking at dispersion measured by the 25th percentile and 75th percentile in the University of Michigan inflation survey. So I think the fact also that salient prices like food and gasoline remain elevated suggests that there is some risk that longer term inflation expectations of household and businesses will continue to rise from the current levels. So what do you do in the current situation? From a risk management perspective, I think it's important for policymakers to ask which situation would be more costly. Erroneously assuming longer term inflation expectations are well anchored when in fact they're not, or erroneously assuming that they're moving with economic conditions, and in this case moving up, when they're actually anchored. And if you do simulations using the board's Purvis model, they suggest pretty strongly that the more costly error is assuming inflation expectations are anchored when they're not. If they're drifting up and policymakers treat them as stable, what ends up happening is policy will be set too loose, inflation would then be moving up, and this would be reinforced by increasing inflation expectations. On the other hand, if the expectations are actually stable and policymakers view the drift up with concern, policy will initially be set tighter than it should, and inflation might move down and might even go below target, but not for long, because inflation expectations are anchored at the goal. So those simulation results, coupled with the research suggesting that persistent elevated inflation poses an increasing risk, then inflation expectations could become unanchored, strongly argue against policymakers being complacent about a rise in longer term expectations. I think it's important to remember that inflation expectations are determined not only by movements in inflation, but also by policymakers' actions to follow through on their strongly stated commitments to return inflation to the longer run goal, thereby justifying the public's belief in the commitment. So obviously the current inflation situation is a very challenging one, both here in Europe and in the US. Central banks are going to need to be resolute, and they're going to need to be intentional in taking actions to bring inflation down. If you think back to the low inflation we had in the pre-pandemic expansion, that really led to considerable research. The ECB is at the forefront of that research, as is the Fed, on how low equilibrium interest rates and the zero lower bound can create a downward bias to inflation and inflation expectations. And the policy implication that some drew from this research was that if policy had to err, it should err on the side of being too accommodative, since it would be easier I'm going to emphasize that. It would be easier to address high inflation than low inflation. Okay. I think the current situation, very challenging one, in which a sequence of supply shocks have contributed to inflation being at a 40-year high, belies that view. I think it also calls into question the conventional view that monetary policy should always look through supply shocks. In some situations, such supply shocks could threaten the stability of inflation expectations, and they would require policy action. So my hope is that this situation that we're in, just as a period of low inflation generated important research, that we'll have a new burgeoning research, and we saw some of it actually this morning, to help us actually understand more about high inflation, the role of expectations, and how supply conditions matter, as well as demand side factors. So thank you very much.
Thank you very much, Loretta. So I must say you were very consistent with what you said 6 weeks ago, but I'm not surprised. So our third panelist is Ulrike Malmondier, who is a professor of finance and economics at the University of California at Berkeley. So I'm very happy that you can join us remotely. This is very much appreciated. And as you probably all remember, Ulrike has not only explained to us why we pay for not going to the gym, but she has also done some fascinating research on the formation of inflation expectations. And she is...
Sometimes older generations are more pessimistic, sometimes younger generations are more pessimistic. Sometimes the different generations have pretty similar views on inflation, and sometimes there's huge dispersion. And noteworthily, in particular in the period of the 70s up to 1980, there was increasing dispersion up to 3 percentage points at the time. Now, it turns out if you're trying to predict these cross-sectional differences, after accounting for your usual suspects in terms of demographic, wealth, education stuff, but even monetary policy with fixed effect, that individual level lifetime exposure to inflation is enormously powerful. Those are the fitted lines I drew in here, the solid and the dashed lines. It turns out that if you give me your birth year, I get data on the inflation you have experienced over a lifetime so far. I average it with somewhat declining rates. There's some recency bias. I get a lot of predictive power. So our personal experiences seem to stay with us. We tend to put more weight on realization experience over our lifetimes than other historical data. In some sense, this is a relative of the adaptive learning models, but the big difference is that it's crucial not just to say, oh, people overrate recent realizations. Everybody puts too much weight on the last year or last 5 years or whatever you prefer. No, it depends. If you're 20-year-old, you have seen, what happened in the last year or two, and then before that, you have not seen. If you are 60-year-old, you remember the 1980s.
Ulrike, we have a slightly broken connection, so maybe it's better if you turn your video off. I think then we can still see the slides, right? It's possible. Maybe that's better, because we sometimes lose your voice, unfortunately. Thank you.
Okay. And please interrupt again. I'm happy to kind of just go back a slide. But what I was trying to say here is that there's lots of data now on past realizations having an overproportional influence on our expectations, actually not only in inflation, also in the stock market, for example, in unemployment experiences. Stay with us, remain cautious spenders for years to come, even if life cycle consumption savings models would say otherwise. And these effects do not only affect what we answer in the survey question of inflation expectations or other expectations, they affect actual decisions, as also Ricardo alluded to, in this case, investment long-term bonds. Are you shying away from it? Do you buy a house or not? Do you use it fixed rate or variable rate mortgages, etc.? Now, while I'm focusing here on households, I do want to pause and say it's not only households who exhibit this behavior. In one of their New Zealand manager papers, this one, the Brookings paper by Kumar, Afrusi, Quabian, and Boronichenko, they asked managers of the New Zealand firms, how do you typically form your inflation expectations? And the top 4 answers included shopping experience and prices of competitors and suppliers. So in other words, the prices they see around themselves right now in the recent past have an overproportional impact on their forecast of future inflation. There's also meetings and discussions, so information you get from other people, but it's not financial advisors, it's not monetary policy experts, it's actually people like me, co-workers and family. And it seems to be the case that information coming from people who identify with information that resonates seem to have an impact, and maybe we can get back to that later in the discussion, thinking about what the central banks could do. But finally, after covering households and firms, I do want to talk also about monetary policy makers themselves being strongly affected by their prior experiences. So my favorite example is a guy born as Heinrich Wallich in Berlin, in Germany in 1914 into a family of bankers, lived through Germany's hyperinflation in 1923, and then emigrated to the US in the 1930s, where he had a very successful career in the Fed system, first in New York Fed, got a PhD at Harvard, Fed governor from mid-70s to 80s. To my knowledge, he still holds the record in Federal Reserve history of dissenting the proposal of the chairperson, and kept warning people that, you know, they don't understand the dangers of inflation, how it's around the corner, it's imminent, etc. So why I love this anecdote so much, and I think right now Henry Wallach would appreciate being cited during the current period, is that this is clearly a highly educated person, has all the inflation data at their fingertips, models available, knows that he's in a different country in a different time period, and still cannot shake that experience. But I do not have to go to him. I can also look at the semi-annual monetary policy reports and the forecasts, one-year-ahead forecasts members make in those. If you correlate them, if you plot them again, their personal experience-based inflation forecasts. So I get, you know, Loretta's and everybody's birth year, look where they lived, and calculate their lifetime average of inflation experience. I get to predict why they deviate from their staff forecast, and very strongly so. So why is that? Why do our personal experiences stay so strongly with us, even if we are highly informed, know the models, etc.? Why does it on the margin push us quite strongly in one direction or the other? Well, the message today might be that we should pay a little more attention to neuro rather than knowledge, whether we have the information. We should acknowledge that as, you know, living and breathing organisms, our brain keeps changing as we walk through life. Every new experience leads our brain to form a new connection between neurons. These synapses tell our body to react how to react to the world around us. Importantly, for the inflation situation we are discussing, how and how often we make an experience matters. So Loretta mentioned repeatedly gas and food prices, which get this overproportional weight. That's exactly consistent. If you have repeated stimulation, or particularly over a prolonged time, that causes long-term potentiation. Every time you go to the gas pump, you see the higher price, you can just not stop your brain from forming a strong association between gas and high inflation fears. In fact, the word fear is important here because neuroscientists talk not only about synaptic tagging, but emotional tagging. Emotional events attain privileged status in memory. So if this would result in some kind of panic, anxiety, fear, that's how we ensure that's really deeply ingrained in the population, which of course we would want to avoid. Learned knowledge, you know, as much as we finance professors think we can fix this by explaining the seasonal AR4 model better of inflation, has very limited power to undo this. I think a good reference is the literature on trauma, how synaptic changes are caused by traumatic stress. And it's a good reference also because trauma is not only the big T trauma, you know, traditional, I mean, in the neuroscience literature, the war experience, adverse childhood experiences, or in the econ environment, the German hyperinflation or Great Depression or pandemic. No, there's small T trauma. The daily exposure to increasing prices, even if that doesn't completely destroy your livelihood, the daily worry about food insecurity, unemployment insecurity, which reshapes and reforms our brain and leads us to think differently about the world. One of my favorite examples are those gender differences, which I saw Loretta also mentioning on her, I think, third slide. There is now, I think, over 50 years of evidence, maybe starting from a paper with Swedish data, that women tend typically to have higher inflation expectations. So when we did a survey, we found this even during the low inflation period, this data up to 2015-16, even within households, the male and female heads of household differ in their inflation expectations, controlling for everything. Where does that come from? Well, it's not literacy, it's not education. It turns out that the prices males and females see in their daily life have a lasting and strong impact. So what we did, for example, is to look at who does the grocery shopping in your household. So traditional gender roles makes that very much the woman still. However, in those households where the man indicated that they do at least some of the shopping, the gender differences in inflation expectations completely disappears. And that, of course, then reflects the highly volatile food prices where people tend to latch on to the increases rather than decreases. So to conclude, in terms of implications for monetary policy, the experience effect perspective kind of highlights 3 or maybe 4 things. First, frequency of being exposed to signals is really important. This explains the overproportional roles of food and gas prices, personal shopping. So from a monetary policy perspective, it will be important to acknowledge it and understand that that's the lived reality of consumers, rather than just saying, well, those high volatility items, they really just obfuscate actual inflation trends. Let's just focus on core inflation. If we do want to understand where expectations come from, we need to acknowledge frequency more. Similar to duration, inflationary experiences are extra powerful if they remain high for a long time. The effect will last for a long time. So you might want to account for that in your policy choices, that once we're back to 2014-15, people will still be different. They will still make different spending decisions and form different expectations. This is particularly true if these events get emotionally anchored. Panic means strong anchoring in memory. So obviously, it is key from a monetary policy perspective to try and combat that, but not by kind of trying to teach people, oh, food and gas, that's only 15% of a typical urban consumer's consumption bundle. No, acknowledge that's their lived reality and reassure it. Maybe use more resonant channels of information conveyed by people which know their world, with its managers, which live in their managerial world, face those prices to convey this information. And then finally, I also wanted to talk about the anchoring topic, which is of course on our mind. And to some extent, the perspective of experience effect breaks a little bit the link, maybe to the usual way we think about credibility, right? So normally we think of inflation is well anchored around, say, the 2% target. Oh, that means the central bank is credible and can, pursue effective monetary policy. The perspective I have been giving you says, well, their expectations very much reflect what they have experienced. So if that says 2%, they will answer 2%. And if that says 5%, they will say 5%. It does not necessarily undermine the credibility in the sense that the central bank is not clear on their triggers for decisions and is not following through, etc. So expectations are important in that they show whether the central bank is doing its job, but just in the sense of fighting inflation reality, then the credibility. As a result, some of the monetary policy topics, such as forward guidance, might not be as powerful as we have thought. I'll stop here.
So thank you so much, Ulrike. I think I didn't promise too much. So I very much hope that you are also going to talk in the discussion a bit about the kind of innovative proposals that you had, how we, what we can actually do to also, reach these portions of the brain that may at the moment be affected by high inflation. So we're now moving to our final speaker, who is Erik Nielsen, a Group Chief Economic Advisor at UniCredit. So he is the person sitting every weekend in a Berlin cafe to write his very popular Sunday rap, to which one may not always agree, but which is always thought-provoking. And we're, of course, very curious to hear your views a bit also from the market's perspective.
Thank you.
Thank you very much for being here.
Thank you. Thanks for having me. Thanks for inviting me to Sintra again, and thank you for inviting me to this panel. Very honored to be here. I am, as you said, or like Ricardo said, I'm from the dark side of the markets, who are not only paid to be different, but also always wrong, I think you said. So let me try to give you the perspective from the market, and not only markets in terms of financial markets, but also markets in the corporate sector. We are a corporate bank, so my most interactions with clients are actually with European corporates and what we hear from them. So I try to give you a sense of this. Certainly, one thing I would say is that the conversations in markets, both financial markets and corporate markets,
picked up very dramatically this year. I mean, this was the discussion of inflation is something we did talk a lot about before, way back to some extent, but certainly this has picked up. So this is a really hot topic and very important, obviously. If I can just summarize, the key message I hope you take away from what I say today is the following. Inflation expectations, certainly the medium-term to longer-term inflation expectations, are definitely really important for the credibility of the central bank. No question about it. I will not doubt that one moment. But my sense, in my assessment this year, the amount of, or the impression I get is that the use or indicating changes to the steps, I think is excessive. There's a risk of being too pointy. Monetary policy, I don't need to tell you, but monetary policy is more an art than a science. And yes, data dependent, but my key message here is that I worry a little bit that there is paid too much attention to it. And let me try to illustrate that very quickly by sort of two segments on what I'm going to say. First, the market-based inflation expectations. I have sort of two key concerns. Number one, what Ricardo talked about with a five-year, a little bit dramatic how it's gone up. Five-year is volatility. It came down as Ricardo said, I'll just remind you, we were down at 175 earlier this year, then it jumped up or moved up to 2.5, and then less than 3 months ago, and now it's back at around number 2 or thereabout. Which, if I were a central banker, I'd say very good. No drama. People are believing in us, and rightly so. But it's volatile, right? So, and remember, I don't need to remind you, but monetary policy has a policy-relevant horizon, which is not a point that I have for the worry about the market-based or what we read in the markets is what you have said in several of your speeches, and Philip Lane also and others, which is that it's kind of a messy instrument, right? It's if you have to try to take the liquidity and risk premium out, and I could have shown this chart that you had, Isabel, a couple of months ago in one of your many fantastic speeches, where you looked at the inflation risk premium on a 1-year, 3-year ILS. And what I saw from that was that premium moved from deducting 80 basis points early in 2020 to adding 40 basis points at the time you spoke. And it's about the same place now, I think. That's a whopping 120 basis point shift in that noise inside what would have been the policy relevant period, right, from 2022 into 2022 into now. So interesting, and it's important work, but I take away from this that this is again, as I said, too volatile and too many distortions. And I know I'm stepping into dangerous territory now, but it's looking at that as a guide for policy direction. It's a little bit like the focus on the neutral rate. Neutral rate, fantastic economic concept, wonderful. Exposed is anti, we don't really know. So this is a really, I think it's an important thing to do, to worry about. In other words, and this comes now to Ricardo's point of my professions, having spent my life, if you adjust the market-based inflation expectations for the noise, it really becomes not much more than a weighted average of professional forecasters. And we have not been very good, right? It's like the fact is that I've done this for 25 years and I will eat humble pie with anybody around here. We've been terribly wrong. I mean, the fact of the matter is the market's prices something they expect, but they don't know anything about the future more than we do or you do. So it's like, so to be too, using it as a tool, I worry about. Now, that leads me then to just a more sort of anecdotal side to this. It's a good time to tell you that since the ECB, which is part of the major central banks I spend more time thinking about with clients, sort of moved on from financing conditions as a key measure that was always measured or talked about to normalization, and then inflation expectations. an enormous increase in conversations picked up. So clients called from the financial markets, for corporates and what have you, an enormous rich discussion pursued. And the only thing I can take away is that even market professionals suffer from the same thing as research shows that the general public and corporates and households suffer from, which is basically a lot of lack of knowledge probably. Many people don't really know what inflation is. I mean, sort of what index we're talking about, what's in it. They generally, until a couple of months ago, overestimate what inflation actually is. They also do not seem to know, most people, that generally speaking, inflation expectations have been higher than actual inflation turned out to be. So there's a lot of confusions out there. That was the first segment, and I am right on time. The second point I want to talk briefly about is the survey-based. And I'm only talking about the medium longer term. I think short term should not really worry anybody. And I have three observations. The first one, they are also prone to change or revisions. And I will say with all respect that when the University of Michigan revised its inspection number last Friday, I have never spent so much time talking to financial market participants about a revision of a number from 3.3 to 3.1, and we know why. So this was become the only conversation the markets have for a good long time. So that is a one thing to maybe keep in mind. It's one number. Then there's a second question, which is reflecting what I said before, namely that is from my conversation with our corporate clients, who are many of them part of the surveys, not completely clear that they know what they're being asked or what they reflect on. There's often confusion between micro and macro. Do they talk about input prices or can they put on to output prices? That's a conversation now. There are questions about the index, which one it is. Is it an index they care about, or their personal or their business index? And for bigger or more senior corporates or clients, it's often then confused with asset prices also. So there's a lot of noise in this that makes me somewhat nervous about the usefulness of it. So this leads me to my final point, which is the only reason why inflation expectation may matter, obviously, is the risk that they lead to higher wages and then the self-fulfilling story. And that is certainly something that I respect and I know is a very important. I'm not so sure. I mean, we know economic research shows there is a good correlation, a very strong correlation, but I'm still somewhat nervous now. I can see the ECB's concern about the upcoming wage negotiations, in particular Germany, and the effect of the indexation of minimum wages in France and other places, and then the spill through, of course. I respect all this. I suspect, and I would love to be told I'm wrong, but I strongly suspect that when you see just credibility, I understand that, but maybe I fear a little bit from what I sense from my standpoint, is that there's a little bit too much attention to trying to pick numbers that sort of gives you the story that explains it. And then the risk is that one picks individual numbers that are very, very volatile and maybe not so meaningful. So my 2 cents worth would be that we all understand it's very, very difficult to run monetary policy. And I wouldn't set policies on the basis of 1 or 2 individual numbers. Thank you very much.
Is back. And for the first time since before the 2008 financial crisis, the European Central Bank, the Federal Reserve, and the Bank of England, along with a host of other central banks, are all tightening monetary policy. But the threats to growth are immense too. Policymakers face a delicate balancing act between stamping out inflation and avoiding a recession. Ladies and gentlemen, for traversing this narrow path, Francine Lacroix, editor-at-large at Bloomberg, will be moderating the session. Francine, the floor is yours.
Claire, thank you so much. Now, we're here at the ECB Forum on Central Banking, and every year it's very clear that Sintra really dominates the attention of investors, but not every year is like this one. Now, for one, it's not, I'm told, quite as windy as it was yesterday, but that, of course, is not what makes this year so special and so unique. We're entering a new chapter for monetary policy, a divergence for almost 15 years of policy experimentation in an age really defined by stubbornly low inflation. Now, this year that has changed. As Claire was saying, our policy panel needs a little introduction, but I'm going to do it anyway. Jerome Powell is the chair of the U.S. Federal Reserve, Andrew Bailey, governor of the Bank of England, Agustin Carstens governed the Bank of Mexico before becoming general manager of the Bank for International Settlements, and of course our host, the president of the ECB, Christine Lagarde. Now, just a reminder, between them, these institutions hold nearly $20 trillion worth of assets on their balance sheet, and they've of course maintained ultra-low, even negative interest rates for the better part of a decade with little disruption. They now have the unenviable position of presiding over the great unwinding of policy that may have permanently changed the architecture of global markets. So thank you all for joining us. We're going to have, I'm sure, a robust discussion over the next 90 minutes. Mr. Carstens, let me start with you as a central bank of central banks. You know, central banks in general have faced really a succession of crises over the past years, but also some of the structural factors, such as the green transition, digitalization, and increased onshoring. So how different will the future of inflation be from now on? How different will it be from the last decade?
Well, I mean, a very important change that has taken place in the last, I would say, 2 decades, or even more. If, for example, we compare this period of inflation with the 70s, is that we have much stronger institutional monetary frameworks and institutional framework for central banks, and I think they're far better positioned to combat inflation. If we go back 70s, and 70s have become a natural reference, we were at the time where, for example, in the Bretton Woods was failing. You don't have more, I would say, instability in a system when you are, for example, revising your exchange rate regimes. And that is not happening today. I think that the period of disinflation there established very strong basis to create new and more nimble, more agile, better prepared central banks. And I think, for example, the design of the ECB, our host here today, in a way incorporated many of those learnings. So, I mean, when you are in charge of combating inflation, what you need to be able to anticipate is that sometimes you will be surprised, because there are many elements that affect inflation and that they are not directly under your control. And I think to a large extent, this is what we are seeing today. And I see a very strong ability of all central banks to analyze, to incorporate that information and to react. For me, if you look very careful what is going on right now, in the last 2 years, we have seen dramatic changes in the environment. We went from having a situation where depression was felt, was feared, deflation was coming, to a very quick rebound with the vaccination and so on and so forth. And we moved tremendously quickly from an environment of fearing deflation to fearing inflation. And that has been compounded by the Russian crisis. I have to say, monetary policy, as nimble as it can be, cannot respond with that celerity. So I think that the knowledge of the new form of inflation is being learned and is being responded. So I'm very positive that this institutional framework and strength of central banks today will take us to the goal where we want to be relatively soon.
Chair Powell, do you agree? I mean, when you look at complexity and uncertainty, has it always been this way, but we forget about it? Or is this really a new frontier?
So I agree with everything Augustine said about institutional progress. But I would add this. We've lived through a period of disinflationary forces around the world. This is globalization, aging demographics, low productivity, technology enabling all of that. And that was So we've been in that world where inflation was really not a problem in most of the advanced economies most of the time. Since the pandemic, we've been living in a world where the economy is being driven by very different forces, and we know that. What we don't know is whether we'll be going back to something that looks more like, or a little bit like, what we had before. We suspect that it'll be kind of a blend, but in the meantime, we've had a series of supply shocks. We've had very high inflation now across the world, certainly through all the advanced economies, and we're, to Augustine's point, we're learning to deal with it. Our job is to find price stability and maximum employment, in the case of the Fed, in this new economy with these new forces. And it is a very different exercise than the one that we've had for the last 25 years. Nonetheless, the goals are the same.
So I don't know whether, Madame Lagarde, after this volatility, do we go back to something that resembles the last 10 years, or is it, something else completely?
I also agree with most of the points that Augustine made, and we don't have to agree between us because we always do. But I don't think that we're going to go back to that environment of low inflation. And I think that there are forces that have been unleashed as a result of the pandemic, as a result of this massive geopolitical shock that we are facing now, that are going to change the picture and the landscape within which we operate. If I look at our euro area, for instance, we have record low unemployment. We have inflation expectations, however unprecise and with the pinch of salt that was discussed at the last panel, which was excellent, we have inflation expectations that are much, much higher than they were. That's for the internal matters. But if you look at the rest of the world, a lot of the movements that we've experienced in the last 20 years was predicated on globalization, on the breaking down of supply chains, on the reduction of cost, on the just on time. That has changed and will probably change continuously to a system that we are not certain about at this point in time, which is much debated. Some would argue that globalization will continue in a different format. Some would argue that the place where you manufacture, the place from which you provide services is good. As a result of the pandemic, as a result of this massive geopolitical shock that we are facing now, that are going to change the picture and the landscape within which we operate. If I look at our euro area, for instance, we have record low unemployment. We have inflation expectations, however unprecise and with the pinch of salt that was discussed at the last panel, which was excellent, we have inflation expectations that are much, much higher than they were. That's for the internal matters. But if you look at the rest of the world, a lot of the movements that we've experienced in the last 20 years was predicated on globalization, on the breaking down of supply chains, on the reduction of cost, on the just on time. That has changed and will probably change continuously towards a system that we are not certain about at this point in time, which is much debated. Some would argue that globalization will continue in a different format. Some would argue that the place where you manufacture, the place from which you provide services is going to be determined by different factors than just cost. It will be about cost as usual, but it's also going to be about where do I locate my services, where do I employ people, where do I reduce my costs, and are those areas, geographical as well as political, actually foes or friends? And do I have some predictability about the future of my production or the providing of my services? And the third factor that is going to change the scene from my vantage point is the way in which we produce. And I think that the shift that we're observing in Europe, certainly, towards green transition is also going to change dramatically the way in which we operate. And all those forces are going to produce inflation, deflationary impact that are still to be measured, but in the short run, I have some ideas as to where it's heading.
And we'll get back to those ideas shortly. Governor Vela, do you see this as a sea change for the longer-term future?
Yes, I do. I mean, I think first of all we have to say that unquestionably, of course, our task is to return to low inflation. But I think, and we see this, every day, that in fulfilling that task, we're observing certainly, what can turn out to be structural change, and some of it, I think, I would say is already getting there. So I think COVID is leaving a structural legacy on labour markets and the way they behave, which we're already beginning to see. I think sadly the European security situation has changed. We hope it obviously doesn't persist, but it has changed, and that's affecting, as Christine was saying, that's affecting supply chains. It's affecting the resilience of the whole supply system. And you mentioned climate change, Francine. I would say that this is not, because some people sometimes say this is not some sort of dilettante activity by central banks. The reason that we're not in the lead on it, clearly, but the reason we have to take it seriously is because it is affecting our world, and actually it will get worse. That's the sad fact of life, and we have to, in a sense, understand that and understand what effects it will have and how we respond to it. So these structural changes, are very important in our landscape.
So, Chair Powell, as these complexities or as these sands are shifting, is slower growth, much slower growth, an inevitable trade-off on trying to deal with inflation?
So I would say that if what we see, for example, is the redivision of the world into competing geopolitical and economic camps and a reversal of globalization, that certainly sounds like lower productivity and lower growth. And in many parts of this side of that, you see aging demographics, so a shrinking workforce, and you see economies that are growing more slowly and whose workforces are not expanding. So that's certainly a possible outcome, and I think probably to some extent a likely outcome.
And in the shorter term, can the economy, can the U.S. economy actually deal with, a possible onslaught of interest rate hikes?
So the U.S. economy is actually in pretty strong shape. So if you look back a year, the U.S. economy grew more than 5.5%. It was really the big reopening year. Mm-hmm. And so we had expected this year to be that growth would moderate to a more sustainable path. We also, of course, are raising interest rates, and the aim of that is to slow growth down so that supply will have a chance to catch up. We hope that growth can still remain positive. But if you look at the strength of the economy, households are in very strong financial shape. They've still got a lot of excess savings from forced saving from not being able to travel and things like that, and also from fiscal transfers. So households are overall, not every household, and not the ones at the lower end of the income spectrum, but overall in strong shape. The same thing is true of businesses. Very, very low rates of default and things like that. Lots of cash on the balance sheet. The labor market is tremendously strong, still averaging very, very high job growth per month. So overall, the U.S. economy is well positioned to withstand tighter monetary policy, we think.
But is it automatically a trade-off between fighting inflation or taking care of the economy, and how far are you willing to go with interest rate hikes?
So I guess I'd say it this way. Our aim is to have growth moderate. It's sort of a necessary adjustment that needs to happen, so that again supply can catch up. It could be supply of workers. It could be time for the supply chains to improve. So the sense of that is that if we can get right now, supply and demand are really out of balance in many parts of the U.S. economy. Labor market being a big example of that. We need to get them better in balance so that inflation can come down. And that's the aim of what we're doing. Now, we don't have precision tools. Obviously, monetary policy, famously a blunt tool. That is our aim, that is our intention. We think that there are pathways for us to achieve that, to achieve the path back to 2% inflation while still sustaining a strong labor market. We believe we can do that. That is our aim. There's no guarantee that we can do that. It's obviously something that's going to be quite challenging, and I would also say that the events of the last few months have made it significantly more challenging. Thinking there particularly of the war in Ukraine, which has added tremendously to inflationary pressures around food and energy commodities and agricultural chemicals and industrial chemicals and things like that. So it's gotten harder, the pathways have gotten narrower. Nonetheless, that is our aim, and we believe that there are pathways to achieve that.
President Lagarde, can you talk to us about this fine balancing act for Europe and what that means?
Well, what I find extraordinary is that sort of 10, 15 minutes into this debate, we haven't really used the word energy. And certainly in this part of the world, the energy shock that we have suffered, are suffering, and probably will continue to suffer, has had a major impact. And I think this is not specific to Europe, but there is certainly a dependency of European countries, and the euro area is certainly a point in case, to external supply from foes. And that has had a major impact on prices. It is certainly a very driving force, a strong driving force of the inflation that we have experienced in the last few months. This has been, as you said, Jay, exacerbated by the war. And I think the proximity of Europe relative to the war scene has had probably a more significant impact on the price both of energy and of food, which are clearly very important components to take into account, including in inflation expectations, as was discussed earlier. But we also have, that then is a series of supply shocks that are hitting the European economy. But we also have this recovery that is very much underway. That is certainly driven by services because of the swing that we've observed from goods to services, and which is also supporting the economy. We have very low unemployment numbers, high employment participation. Some of it is more attributable to public service jobs than private sector, although that is also back to pre-pandemic moments. And we have a couple of other items, such as significant savings that are still to be used, hopefully, or not. And we have fiscal policy. And the fiscal policy that we are seeing at the moment is roughly in the range of 1% GDP. But we need to see how fiscal authorities move, where they move, and we certainly hope that they will move in a targeted, temporary way in order to make sure that they support the most vulnerable and not in a broad and discriminated fashion as we have unfortunately observed so far.
Why do you prefer actually the more gradual approach? So yesterday you reiterated 25 basis points hike.
Gradual for monetary policy?
For monetary policy.
Well, don't forget, I didn't say gradual full stop. I said gradual but optional. Yeah. And I think it's a combination of the two that actually matters for us. Moving gradually is certainly appropriate in times of very high uncertainty, but as the uncertainty will clear on various accounts, we will have to certainly be less gradual and give more weight to optionality. But we have both of them in combination at the moment, optionalities being also a very critical aspect of our determination.
Mr. Carson, you've been pretty vocal actually on what central banks should do. Do you think they need to cut faster?
Well, I think everyone should react according to their own circumstances. What is very satisfactory at this stage is that pretty much all central banks have starting address the issues. One way of dealing with it is through words, to recognizing you have a problem, to saying that you will address it, and pretty much all have already entered into the field of action. So central banks have been acting in consequence. I have to say the level of interest rates worldwide have adjusted. The level of interest rates, if you look them from the yield curves, they have been increasing quite substantially. What we can say is that global financial conditions have tightened substantially, because we don't have to, we shouldn't forget that this in a way has become a global phenomena. Inflation around the world has been increasing. Now, each country, as Christine and Andrew and Jay has been saying, each one face different dynamics of inflation. In a way, I think what is very, very important is that in the realm of their own economies, what they should try to do is.
All right, everyone. So what we're gonna do is 5 minutes till open. So we're gonna quickly take a look at the markets. This thing is gonna go on for like another hour. So we'll kind of tune in, tune out when Jerome Powell is talking and Christine Lagarde is talking. I know it's really, really, really difficult to keep my eyes away from the chat when this guy is talking, because you guys are hilarious. This is such a funny group. It's just so difficult for me to not keep a serious face, you know what I mean? But anyway, we've got the QQQ slightly flat, more or less flat, not really moving all that much, up over 3 basis points. You got the SPY up over 22 basis points, and the Dow Jones is up a little bit over 34 basis points right now. So definitely a very strong move to the upside. The 10-year yields are slightly down about 9 basis points, trading at just over 3.172%. And some of the individual stocks also more or less flat. We're not seeing a lot of momentum here pre-market, neither to the upside nor to the downside. So, you know, Google is slightly down about 23 basis points. Tesla's down almost 90 basis points. I'm seriously, I can't stand looking at the chat because I knew it. The first time he came on board, I absolutely knew it, that the chat was just gonna go crazy on that. But Tesla trading at 691. So obviously yesterday was a very brutal day across the board for a lot of individual stocks and for the overall markets, especially the tech sector and the NASDAQ. And today we're basically just starting off flat here. Also remember that today is the 29th, tomorrow the 30th, and the NASDAQ has 2 days for closing out that monthly chart above that 50 exponential moving average. So this right here is the 50 EMA. Very, very, very important level. So this right here is going to be the level to watch on the monthly chart, and that's the 50 EMA that we're watching at 11,100. So right now we're at 11,181. And the implied open, I think, is going to be roughly around 11,175, around those levels. So it is going to be very critical for the market, especially the NASDAQ, to hold above that support, that 50 EMA. And of course, if you kind of go back to the historical charts, only 2 times in the last, you know, about 40 years or something, close to 30 years, that the NASDAQ has broken down below that 50 EMA. So that was during the dot-com bubble, and this right here was during the Great Recession. So we'll see where this month closes. Even during the COVID crash, during the March 2020, we were obviously selling off that month of March, but then we got bought up to close above that 50 EMA. That's the yellow line you guys see on the chart, and right now we're just sitting above that 50 EMA. So again, it's going to be very interesting for us to see what happens over the next 2 days and whether we see some momentum to the upside or not. So, okay, the market's going to open in about 3 minutes. I'm going to tune back in to that, and we're going to continue kind of listening. It's going to go on for, you know, a little bit longer. But yeah, we're going to tune in, tune out. You know, if there's anything important, we'll listen in and then look at the markets as well. See how individual stocks are doing, how individual indices are doing. And then obviously, if you have any questions, just let me know. So, okay. Yeah, so we did have the poll. By the way, we had so many votes today. I'm really surprised. We had over 540 votes on that poll. So thank you for everyone who participated. Obviously, 49 to 50% expecting the markets to be red, I think, and close to 30% expecting the markets to be green. And the rest was the expectation that it's going to be flat. So right now, we're just consolidating sideways. Not a lot of movement. AMD and NVIDIA, some of those chip stocks have been under a lot of pressure. Because of some semiconductor issues, once again, with supply chain issues and chip shortages again, kind of resurfacing. So we got NVIDIA down 1.2%, and AMD is down a little bit over 1.5% right now as well. Let's take a look at Upstart. A few people talking about Upstart here. Down 12%. Wow. Quite a significant move to the downside here. I think it got a couple downgrades. So let's take a look. This is from June 3rd, but I do think that they got a few downgrades on the stock right now. So down pretty much 12%, trading as low as $31. So, okay, let's listen in and we'll keep a close eye on the indices. Got about a minute 20. We've got the NASDAQ over here, S&P 500 at the bottom right. This part of the screen is going to be mostly covered because of the ECB forum. But let me know if you can't see any stocks over here. I'll kind of switch around the screens and we'll see individual companies in some of the different panels as well. Let me just break this down like that. So we'll keep a close eye on Tesla, top right. We'll keep a close eye on Amazon over here. And then bottom right, we'll keep a close eye on Apple. And then we'll keep a close eye on Meta over here. Okay, let's listen in.
This very personal thinking on interpretation, for example, Chair Jay Powell, I mean, I tried my luck with Governor Bailey, but how do we, how should we be thinking about this? Like, is it, markets or reporters trying to really always get just that nugget piece of news?
Yeah, well, certainly there's a lot of that going on, I would say. But no, I guess I would, to put a more constructive spin on it, the markets and market participants are always wondering what we're going to do. They're always wondering what we're thinking. And when market moves happen, that's really a constructive thing. It's never going to be exactly what we're thinking, but nonetheless, it's constructive that the market in effect is doing your work for you if it correctly understands your reaction function. So that's maybe a more constructive way to.
And is it correctly understanding what you're saying right now?
So I would say, by and large, I think over since last fall when we pivoted to raise rates and get where we are now, since then markets have been pretty well aligned. I wouldn't bless any particular day, for example, but pretty well aligned with where we're going. And right now, the market pricing is pretty close to where the summary of economic projections from, 2 weeks ago was. So my colleagues and I wrote down numbers for the end of this year for our policy rate between 3 and 3.5%. And markets are broadly right in that space somewhere. And then for next year, between 3.5% and 4%. So broadly speaking, I think it's working. And, everything we say in terms of forward guidance, to your point, is always going to be conditional on the things that happen between now, when you give the guidance, and when the actual event happens. And sometimes markets can forget about the conditionality part.
But is there a problem actually with forward guidance in this kind of environment because it gets priced in straight away? So it feels sometimes like, markets lead and central banks follow because of the forward guidance.
It doesn't really feel that way at all from where I'm sitting. It feels quite the opposite. And no, as I said, I think people will look back on this period and say that we were able to have financial conditions.
Yes.
To raise rates and get where we are now. Since then, markets have been pretty well aligned. I wouldn't bless any particular day, for example, but pretty well aligned with where we're going. And right now, the market pricing is pretty close to where the summary of economic projections from, 2 weeks ago was. So my colleagues and I wrote down numbers for the end of this year for our policy rate between 3 and 3.5%. And markets are broadly right in that space somewhere. And then for next year, between 3.5% and 4%. So broadly speaking, I think it's working. And, everything we say in terms of forward guidance, to your point, is always going to be conditional on the things that happen between now, when you give the guidance, and when the actual event happens. And sometimes markets can forget about the conditionality part.
But is there a problem actually with forward guidance in this kind of environment because it gets priced in straight away? So it feels sometimes like, markets lead and central banks follow because of the forward guidance.
It doesn't really feel that way at all from where I'm sitting. It feels quite the opposite. And no, as I said, I think people will look back on this period and say that we were able to have financial conditions tighten quite substantially. And we've only had 3 meetings at which we raised rates. Nonetheless, the forward rate curve is pricing in, a rate path that looks a whole lot like the summary of economic projections that my colleagues and I submitted in June. So that's a good thing. That's the market understanding and finding credible what we're writing down. Now, of course, it's all highly conditional, but nonetheless, I'd say that's a positive thing.
Yeah. Do you agree, Madame Lagarde? Is it a positive?
Yeah, I would agree. From our vantage point, we are on a normalization path. We have signaled that very clearly. We've started that back in December. And, the key assessment is the assessment of the medium-term outlook. The variables that we look at, the data that we look at, I think, everyone is aware of that. And most people operate on the basis of the same data, the same information. And I think that our reaction function is what matters. And as long as that is understood, the fact that we are on this normalization path, that we are gradual but optional, that we're going to be data dependent, we've indicated very clearly what's likely to happen in July. Yes. What's likely to happen in September? Yes. And, in the path that we are on, I think that markets have full understanding and appreciation of what we are doing, how we're doing it, and then the level of uncertainty as it clears will probably help us towards this optionality that I was describing earlier on.
Governor Bell, do you agree actually with the market function so far? Have they broadly understood what the central bank's trying to do?
Yes, I think they have. I think the tricky thing that you see, certainly I would say we see, is that we can obviously see direct market pricing. We can have an implied market curve which prices in what we're going to do. We also, as you probably know, and we just started doing this recently, publish a market survey at the same time as the meetings, and that actually shows a lower path of rates. So we spend quite a bit of time understanding the difference between those two. I don't think it's actually hard to explain, because I think the underlying reason is that the market curve prices in the risk, and the risk is on the upside, and I would agree with that. So whereas the survey is a straightforward, point number, the curve has got the risk in it. So I think, for me, the best way to look at that difference is the risk. But that is a risk in that sense. It's important to see that, that perspective.
Yes, absolutely. Not to get ahead of ourselves or to have to become big-headed about it, but there's a point that was made in a previous panel, which we all agreed over lunch, which is that it's not a science what we're doing. There's an element of art. I don't know whether you characterize it as art or not, but it is not just driven by sciences, and we know that models have had their shortfalls, particularly turning points. So there is also that element that is sort of privy to the deliberations that we have in our various governing councils and FOMCs and what have you.
Yeah. Yes.
Can I just add, we're talking a lot about markets and how we react to markets. Actually, to Christine's point, the way we're thinking about it is what policy setting do we need to put down to achieve the real economy goals that we're working on, and that's what we're not thinking, well, let's try to match up with the markets. We're thinking, what's the right policy based on our, the incoming data and the evolving outlook and all those things that will get us to 2% inflation while ideally keeping the labor market strong. So it's really, we're talking so much about markets, I wouldn't want people to think that that's actually what we're aiming for.
We still have an hour on the panel, so we have time. Is there a piece of the? I mean, do you worry about yield curve inversion though? Is there a piece of that makes you worry, or do you just So
I would say this: we monitor a broad range of financial conditions. Honestly, the shape of the yield curve is not a top line worry for right now. Our focus is very intensely on setting policy in order to get inflation down to 2%. That's what we're working on. We understand that that's our primary focus right now. The labor market, of course, is extremely tight in the United States. So our focus is getting inflation under control. It's very important that people understand how committed we are to doing that. And that again, that's what we're thinking about.
Yeah, and I want to go back to the real economy and inflation in a second. But Mr. Carson, what do you make of some of the what we've seen in market volatility? Is it just a readjustment? Is it a misunderstanding? Is there something that could turn uglier?
Well, markets are responding also to the circumstances. I think as policymakers, to some extent, have been surprised because there has been news that really are news and that were very difficult to anticipate. Markets are doing the same. And we have to, and you know this very well, markets are turning around very big positions. They're adjusting their portfolios. We are talking about a circumstance where for very, very long period of time, we had tailwinds in the bond markets. That we had very low and falling real rates of interest, falling nominal interest rates. So trading bonds was relatively simple. We had very big expectations for earnings into the future, a lot of interest in different sectors of the economy. Therefore, it was easy sailing for quite some time. But the world has changed. The world that investors are facing and the world that we are facing. And central banks need to do their work, not as an objective in itself, but as all these central bankers have been saying, to fix a problem, which is inflation, and then continue with a much better world moving forward. So there are certain circumstances in markets where frictions are bigger. Trading conditions are not always the same. I mean, you get circumstances of crowded trades because at some point The same type of investors are trying to do the same operation, and liquidity is not necessarily there. Something that for me has been very positive is that central banks, the leading central banks, have been able to implement their money policy adjustments without really generating such big, any sort of market disruptions. Markets have been performing well, liquidity is there, market making is going forward. Yes, there has been some disruptions. I'm not talking about the cyber world, that's another fish, or how do you say it, another kettle of fish. But I think that the markets have been working really well, and yes, behind the actions of central bank, there is always the concern that markets should be working adequately, because you don't want to have financial instability. At the same time, you need markets working well for the transmission of monetary policy, and so far, I would say so good.
Yeah, but at what point, and I think that maybe the last point on markets is how much do central banks need to deal with markets, Mr. Carstens, to see, to I guess impact the real economy?
That's for you.
Yeah.
How much do we deal with them? Oh, sorry.
Yeah, I mean, how much do you need to focus on markets to make sure that also the real economy is quite strong?
Well, I mean, we spend a lot of time analysing markets, and all of that is fed into what impact those changes have on the inflation outlook. I mean, that's why we do it. With the second objective, as Augustine rightly says, of course, about market stability, because after all, we've also got financial stability obligations and responsibilities. I mean, I think if I go back to the panel this morning very briefly, I think the point was rightly made that it's turning points that are the hardest often to read, and it's not just for us, it's for markets as well. And I think certainly when I look at the UK economy at the moment, it's very clear that the economy is now starting to slow. We are at something of a turning point in that respect, and I think the fact that markets are having to take that on board, and that the data can be quite choppy at that sort of point in time, is reflected in some of the short-run movements in markets. Now, I do think one of the essential things for central banks is to look through that short run. Yeah. We have to extract the information and then look through it, because obviously our objectives are much further forward in that sense, in terms of low inflation and returning to target. But in terms of taking the information out of markets, yeah, it's a very important activity for us.
Chair Powell, Paul Krugman, I think on Friday, said that the number one risk to the U.S. economy is that the Fed could overdo it because inflation could come down as quickly as it went up. Is that really possible?
Well, we'd certainly welcome inflation coming down more quickly than expected, and we would take that into account in our policy. So as I mentioned earlier, we're very strongly committed to using our tools to get inflation to come down. The way to do that is to slow down growth, ideally keep it positive, and as I mentioned, supply and demand get back into balance. So that's what we're trying to accomplish. Is there a risk that we would go too far? Certainly there's a risk, but I wouldn't agree that it's the biggest risk to the economy. I think the bigger mistake to make, let's put it that way, would be to fail to restore price stability. And it's to what Augustine was speaking to earlier, a low inflation environment or regime is what we've had. And that is one in which inflation is low and no one pays any attention to inflation, and that's called rational inattention, because it doesn't matter. When there's a big inflation spike, if it's going to go away, we would ignore it and sort of play through it, because it'll go away and it won't affect people's understanding. But to the extent there are a series of shocks, it does become rational for people to pay more and more attention. And I think the clock is kind of running on, how long will you remain in a low inflation regime where most of the changes in inflation are actually idiosyncratic as opposed to broadly across the macroeconomy. So the risk is that because of a multiplicity of shocks, you start to transition into a higher inflation regime. And our job is literally to prevent that from happening, and we will prevent that from happening. We will not allow a transition from a low inflation environment into a high inflation environment.
Is there a point where actually so inflation expectations get de-anchored? And is that...
That's another way of saying it or thinking about it. It's the same thing, same idea. And the thing is, you never really know. There's no way to know in real time. We all study inflation expectations very carefully. And if you look across the broad scope of short, medium, and long-term expectation, you'd still say that we have credibility, that they're well anchored. But there's a clock running here where we have high inflation running now for more than a year, and no one should assume it would be bad risk management to just assume that those longer-term inflation expectations will remain anchored indefinitely in the face of persistent high inflation. So we're not doing that. As a risk management matter, we're working very hard on the part that we can affect, which is the demand side. We can't affect the supply side, really, but we can affect the large parts of the U.S. economy where there's surplus demand, and that's really our focus.
Is there a data point that you watch for to actually see whether there is a de-anchoring, or where do you see it first, basically, if it spirals?
The point is not to see it at all. We can't. Once we start seeing that, the cost of dealing with higher inflation goes up so much, to the extent you find yourself in a higher inflation regime, that you just can't allow it to happen. So if you're starting to see serious de-anchoring of, and we're not, of longer term inflation expectations, then you're behind. And I think right now we're doing what we need to do, which is to move expeditiously and into restrictive territory fairly quickly. I think that's what we need to be doing so that we don't find ourselves in that situation.
President Lagarde, what's the situation like in Europe? We had a pretty ugly CPI number from Spain this morning.
Yeah, numbers from Germany that are below what economists expected. So I think it's a question of waiting until the 1st of July when we have the consolidated number for the whole of the euro area, and we'll see, because we are data dependent. But just like Jay, our mission, our mandate, our job is to provide price stability, which we have defined as 2%. So we currently have inflation at forecast 6.8 for this year, moving down to 3.5 and 2.1 in 24. All of that is above target throughout the whole projection period, and we need to do what we have to do, which is to bring it back to 2%, and we shall do so. Now, of course, we are not exactly in the same situation as Augustine was saying. We need to look at our markets, we need to look at forces, we need to look at how the uncertainty that we have on the horizon is going to clear. And I think that in that respect, what happens on the energy front, what happens on the war front, unfortunately, what happens in relation to wage negotiations, and how inflation expectation continue to stay anchored as they have re-anchored, are some of the elements that we will be looking at very carefully in the job that we have to do to bring inflation back to 2% over the medium term. That's the same determination.
Yeah, Governor Bailey?
Well, I agree. I mean, I like Chris.
All right, so we're gonna tune in and out. I'll share the link to this. Again, this is live happening right now, so I'll send the link to all the members in our Discord. I'll share it so you guys can continue watching it, because it's gonna be another hour that they're gonna be talking about it. But overall, we've got the Nasdaq right now just battling through that 50 EMA. I think that is what investors are watching right now. I think over the next couple days, as I pointed out, this is a very, very critical level. I don't think I can emphasize this point enough, because we are literally sitting at the 50 EMA on the monthly chart. Like, we're about as close as we can get. So this is the real test, a real battle between the bulls and the bears. And as I've said before, this is much better than watching UFC, because, if it does drop, then unfortunately it's going to lead to some very catastrophic potential downside if it does break. And if we actually close the month of June below this level, because that would be a breakdown in over 14 years, right? So that's the 50 EMA that we've been just perfectly validating for a long time. And right now we're just sitting above that level. So we'll see what today and tomorrow is going to be for the Nasdaq. We're just at those levels, and right now we're starting to get a little bit of buyers step in, but overall still down about 65 basis points. We've got the Dow over here that's slightly up over 11 basis points, so hasn't really moved all that much, and the S&P 500 is up. Actually down a little bit over 30 basis points right now. You guys are just hilarious, man. I can't. Honestly, like, it's just so difficult to keep a serious face. I feel like you guys have made it your mission to just make me laugh. Literally just break my serious face. But one day, I'm definitely going to do it. One day, for live streaming something, And I promise you, I guarantee that I'll not break it. I'll not break my seriousness. But anyway, Tesla here taking the fall. We're down over 3%, down to 677. So Tesla overall has been trading inside kind of like a horizontal pattern, right? So it's been consolidating sideways for the most part. So this has been the overall consolidation, the range within which Tesla has been trading at for a really long time. And then we've also got some of the semiconductor names. So I actually created a quick watch list for semis. So we can come over here, take a look at them all at once. We've got Nvidia down almost 4%. AMD down to $77, now hitting a new 52-week low, $77.11. And we're down almost 4%. So definitely chip stocks under a lot of pressure. AMD, in my view, I think it's come down to some very attractive levels. I mean, we were at the same levels as where we were same time last year, back in May and June, before AMD obviously had a huge rally of over 100%. And then coming right back down, it's down over 52% from its all-time highs. So definitely coming down to that area of support, that demand. So I will be looking at cash secured puts for this company, or even consider dollar cost averaging personally, because in my opinion, AMD is undervalued, like about fair value to undervalued here, trading at these levels. Intel, Micron, TSM, they're all selling off here on the day. Let's just also add Qualcomm over here. And we are seeing Qualcomm also down 1.3%. Cybersecurity is also down. CrowdStrike is the only one that's slightly higher, up over 28 basis points right now. And then all the banks are more or less selling off, but there's some. HSBC, we got Goldman Sachs pushing higher, Citigroup and MasterCard's also pushing up. Morgan Stanley's higher, JP Morgan slightly up, but we got other fintech names like PayPal and Block, Deutsche Bank slightly down, Credit Suisse, Barclays are all selling off a little bit right now. Upstart, let's take a look. So they did get a downgrade on the day, but look at the amount of buyers stepping in here intraday. So intraday gain for Upstart from where it opened, from lows of $31, it's pushed up almost 6%. Let me see if I can find the actual report on Upstart and see what the actual downgrades and upgrades were. So, all right, let's take a look here. Let's see if we can actually figure this out. All right, let me see. may not be over here, but if it is, we'll take a quick look. So, all right, Barclays initiates Penn as overweight. Raymond James upgrades Ulta to strong buy. JP Morgan downgrades Bath and Body Works. By the way, my battery is about to die, and since I have the microphone plugged in, we've been streaming for almost 2 hours. I think it's been a long time. We started quite a while ago. O'Reilly here, Goldman Sachs, Upstart, McDonald's, Tesla. Upstart's not here right now. Amazon and Microsoft, they reiterate as a buy. And then there we go. So Morgan Stanley downgrades Upstart to underweight from equal weight. And they didn't put a price target, but they see too many downside risks for Upstart. And, you know, if the economy does enter into a recession, then unfortunately there is going to be downside risk for companies like Upstart, for fintech companies. But look how quickly it's getting bought up. It's just crazy. It's only down 5%. At one point, it was down over 12%. Tesla here is starting to come back a little bit, still down 2.2%. AMD is down almost 3%. Nvidia is down almost 3%. Meta Platforms is up over 1.5%, and Amazon is up over 2%. Kind of like a mixed market right now. Amazon's up very nicely. Microsoft's up. So if you take a look at our FANG Mint watch list over here, just this section, Nvidia, AMD, and Tesla down over 2% each. Netflix is flat, but then other FANG stocks, Microsoft, Meta, Amazon, Apple, Google, they're all up at least 1%, with Meta, Amazon almost up over 2%. So a very strong move there for those companies. And we have the NASDAQ, there we go, starting to push higher. We are now green. And you guys were talking, right? You guys were saying that this person, when he was talking, the markets were selling off. Look what he's doing for us. Look what he's doing. The markets are going higher, and he's still on the mic talking. So I'm in his corner. I do think that he's making the markets go higher. So that's great. But yeah, Upstart's getting bought up here. And we'll see what happens throughout the day. But like I said, the monthly chart is very important on the NASDAQ. I think that's the one to really watch. I am on 8% battery. I think we can still go for like at least 10-15 minutes. I don't know, how long do 8% batteries last when you're streaming on YouTube? Do they last long, or do they like die out very quickly? So okay, yeah, I gotta fix my lag. Yeah, I know there's been some lag here in the stream. I mean, that happens. I mean, I've got so many programs running, so definitely, you know, it's it's been a little bit of an issue. But Nasdaq now up over 11 basis points. S&P's up over 22, and then we've got the Dow Jones is up over 0.5% right now. So some of the individual names pushing up. Let's see which stocks are actually down on the day. So we'll go over stocks that are red. Okay. So, all right, stocks are Upstart still down. Mara, since Bitcoin is down, Ethereum's down. Enphase, we got Neo selling off a little bit over to 3%. And then we've got, I do have the charger, but then I'll have to switch over to the mic. The mic won't be plugged in, and the audio would really be terrible if the mic's not there. But yeah, Peloton selling off. Shopify finally having their split, trading at under $34 now. So I'll do an updated analysis on Shopify, see if there's any potential opportunities with that. And volatility here was higher. It was up over 3 to 4%, but right now just up over 74 basis points, so back under 29 levels right now. And of course, oil prices have been pushing higher, so we're seeing a very nice bounce from these higher lows. So nice ascending support over here, and we're getting a nice bounce back higher for crude oil. So that's where we are. A lot of things discussed. Jerome Powell was talking again, so we'll listen.
I mean, I know it's different because
what we're seeing at the moment is more this swing or substitution that was described earlier in the day, where, you know, because of COVID, everybody suddenly decided to stop using any kind of services, particularly if there was social distancing about it, and move to goods. Hence the car industry in the US and, you know, stationary bicycle rather than the fitness club. And now we are seeing this sort of substitution back to services, where people who've been deprived of restaurants, hotels, transportation, theaters, and all the rest of it, that side of it is currently booming and is sustaining the recovery that is otherwise under the various series of shock that Andrew was alluding to. So how these things are going to evolve in view of the uncertainty that we have in front of us here in Europe is something that really remains to be seen.
But how difficult, President Lagarde, is it to, for example, model a gas embargo from Russia?
It has proven. Look, it has proven extremely difficult, and as we have seen from the sort of misunderstanding or wrong assessment that we have seen in the last couple of years, that is difficult for sure. And you know, the rest is for the moment more in the scenario planning world than in the remodeling of what's going to happen on the on gas prices.
Mr. Carson, talk to me about emerging markets a little bit. So first, you know, it's I don't know whether they're coming to their stride because they're used to the volatility, but there are huge implications, of course, of what the dollar is doing.
Yes, of course.
So all right, guys. So that's gonna be it. We've been going at it for almost 2 hours. I think slightly over 2 hours. So we're gonna call it there. I think my MacBook's about to die as well. So I'll send over the link to the ECB meeting that's still going on. Again, it's going to be a live video. You can tune in for yourself if you want to continue watching. So I'll share the link in our Discord. Right now, the markets are more or less flat here. The Nasdaq's up a little bit over, just flat, nothing really. And the S&P is up over 8 basis points. The Dow is doing much better because energy is seeing a little bit of a rebound. And then we've got semiconductors selling off. Tesla's also down. Meta, Amazon doing much better. And then Apple right now is, I think, also slightly higher. So yep, 1.3%, 1.4%. So among the FANG stocks, we still have Meta, Amazon, Microsoft, Apple, Google doing much better. Netflix is down. AMD, Tesla, and Nvidia absolutely getting destroyed here on the day. So thank you so much for joining. I really appreciate it. It was, again, a very, very fun live stream, and definitely very funny as well. So thank you so much for joining. I appreciate it. Make sure that you drop a like and subscribe. If you're new to the channel here, we talk a lot about fundamental analysis, technical analysis, macroeconomics, options trading. We cover a lot of different aspects about the economy and the markets as well. So we'd love to have you on board. And of course, the link's going to be down in the description below for our Discord and our Patreon. 16% discount is still available and valid until tomorrow. So if you want to take advantage of that, link down in the description. So thank you so much. Have a great day, and I'll see you guys first thing tomorrow morning for another live stream. Take care.